What are the challenges with brownfield development? Well, brownfield sites do have a lot of benefits due to their urban location. With that, you have all the local facilities and vital infrastructure such as drainage, electricity, roads, transport networks. They're ready generally nearby and in place. However, there are a broad number of constraints that brownfield developers need to be aware of, and these can have significant costs and program impacts on any development. And if you see each of these constraints that we've outlined here, this is generally the kind of 6 areas that we look at. These need to be fully understood at pre-acquisition stage so that costs are allowed for in any development budget and risks are understood. And those 6 areas really cover around water, with flood risk, SUDS requirements, groundwater, then into historic environment, these are listed buildings and archaeology. And then ecology, where you have a potential for protected species and invasive species. And I suppose the historic environment and ecology are 2 of the areas quite often where there can be significant programme delays in any development if they're not fully understood. But also aligned to that, some more traditional areas you've got to look at regarding buildings, demolition, structural issues, and then what you'd expect with most contaminated or brownfield sites, ground conditions regarding contamination, UXO, mining risk. So there's a huge amount of constraints that can derail any project. And these need to be continually reviewed and understood and built into your cost programme right through from pre-acquisition to master planning and construction phase. But if you align that, there are understanding the constraints, there's a number of opportunities as well. Planning rules such as brownfield registers and permission in principle, brownfield funds and tax relief. These have all been introduced by local government in an attempt to make brownfield development more cost effective. So therefore, understanding tax incentives, which is one of the sure things, it's the surety on any brownfield development, is therefore a very important piece of the jigsaw for all land developers and investors. So without further ado, I'll hand you over to Ben and he'll explain this in more detail.
Thank you very much, Michael, and thank you for the introduction. You're quite right. This does have a role in the overall solution to brownfield development, because the reality is that many sites with planning are still not being developed due to viability constraints, and sometimes and often some tax incentive value being embedded into that appraisal may not make ultimately the difference, but it is certainly a contributor towards a more positive appraisal. And really the purpose of this presentation is just to give the audience some insights into the fundamentals around the value of the tax relief and some of the entitlement conditions. And then I'm just going to cover 5 planning pointers, things that you can do proactively at the outset and during the development phase to improve the value of the relief. The fundamentals. Well, first of all, this is a tax relief that's been around since 2001. But it's amazing, I still encounter plenty of people who have not actually come across this relief. It was originally intended to subsidise contaminated sites with a tax relief called land remediation relief. And then in 2009, there was a redraft of that legislation with some fundamental changes. The first one was the introduction of derelict land relief, which was an expanded amount of eligible costs on sites that are qualifying as a derelict site, and I'll cover that in a bit more detail later. The other thing was, as a result of a number of negotiations we had with HMRC regarding the eligibility of certain works, they actually changed the definition of land in a contaminated state to depart from the Part 2A type definition. So we've now got a slightly odd situation where contamination for the purposes of Part 2A type assessments and assessments of contaminated land generally is different to the definition of contaminated land for tax relief purposes, and that is significant in a couple of key areas, which again I will cover. In terms of cash benefit, there are 2 things to be very clear about here. The actual cash value is dependent on the capacity within which the person doing the remediation is operating. So if they are operating as a developer and they are buying land and remediating it, building something on it and then selling it, the tax relief is worth 50% of any qualifying remediation works, and then the cash value of that tax relief is then multiplied by the corporation tax rate, which is currently 19%. So if you've got £1 million worth of qualifying expenditure, multiply it by 50%, that gives you £500,000 times 19%, gives you £95,000. So 9.5% of the remediation costs recovered, and that is claimed in the year that that remediated site is sold. Okay, so it's 50% land, it comes in the year of sale, and you've actually got 4 years within which to make a claim. Or flip it the other way, you can go back 4 years. So if, for example, you've got a December year end and the current year is obviously December 20, you can go back to 19, 18, 17, 16. You can go back and claim land remediation relief on any sites that have been sold since the 1st of January 2016. So highly valuable in terms of retrospective reviews. If, however, you are remediating a site with an intention of building an asset on there to hold as an investment, either to occupy yourself or to rent out and receive rental income, then that is capital expenditure in nature. To try and simplify this, there is no immediate tax consequence for capital expenditure. So the way the land remediation relief legislation gets around this is they say, if you've got qualifying remediation costs that are capital, you can, through an election process, it's like a tax election, you can treat any qualifying remediation costs as a revenue deduction in the year that it's actually incurred. So you've actually got quite a significant timing benefit here. So you can claim, in the above example I had before of £1 million, you'd be able to claim that £1 million worth of qualifying remediation costs in the year it's incurred and multiply it by 150%. So you've gone from effectively a tax nothing, because capital expenditure has no relief, to 150% of the remediation works times the corporation tax rate, which is then obviously 3 times as much as it is for a developer. So I often refer to this as the sweet spot of tax legislation, because I'm not aware of any tax incentive for anything that is worth more than it is for land remediation relief on capital expenditure. So very good. 3 primary entitlement conditions you need to be aware of. First of all, you must acquire a major interest in land, and that is a minimum of a 7-year lease, which could be a new lease or the residue of an existing lease, or anything above. So freehold will normally be the situation. But fundamentally, if you have acquired a license and you are going to be doing the remediation works under a license, you cannot claim the relief. And I'll pick up on that in the planning pointers later. The second entitlement condition is that you must not be the polluter, or in any way connected to the polluter, or in any way through an inaction on your behalf, you make the pollution worse through inactivity. So become effectively, if you're a knowing permitter and through inaction, the pollution gets worse, then you cannot claim the relief on any aspect of it. What we normally say is that if you are acquiring a site from a polluter, just make sure that there is no commercial interest through a slice of the action type arrangement or any leaseback type arrangement with them, and to have an absolutely clear break, and then you should be all right to make the claim. The third one is you must not be in receipt of a subsidy. And that generally means that if you have grant funding, any works that are grant funded, you cannot claim the relief. But also, and a very common, surprisingly common misconception is that purchase price reductions are seen in the market as a subsidy, slightly bizarrely. And I think the confusion arises because often a brownfield site value will be calculated with reference to the open market value in its clean state, remediated state, less the remediation estimated cost to arrive at its open market value in its current state. And some people see that deduction as a subsidy. And we agreed this with HMRC back in 2002. It is absolutely not a subsidy. And if you are advised in any situation that it is, then I would certainly challenge that. And we're very happy to support you in that if that's the case. So in terms of eligible costs, we've tried to condense the eligible works onto a single slide. And first question you need to ask is your land derelict? And a site is deemed to be derelict if it has not been in productive use since the 1st of April 1998. Now that date has remained the same since this was enacted in 2009. And I have to say, we very rarely come across any derelict sites that are fit for development, because if they've been derelict that long, it's often for very fundamental structural issues. An element of tax relief is unlikely to make the difference to make the scheme viable. But if you have got a derelict site, then you get this very prescriptive list of 6 qualifying costs down on the bottom left of the slide. And it's not allowed by analogy, it's very specifically those items only. And it's very rare in tax statute to define works in such specific ways. It's normally by definition. So in many ways, it's useful in terms of guidance and clarity over what's qualifying, but you only get that if your site is derelict. Irrespective of whether it's derelict or not, the broader question is your land contaminated? And this is where the definition departs from the Part 2A that I was referring to earlier, in that they drop the reference to substance and they say, is there something, aka anything that is in or under the land that can cause relevant harm to the 4 primary receptors that are more familiar: living organisms, water systems, ecosystems, and buildings. So the caveat they say to that is that something must be from an industrial activity. Now that's not industrial as in an end use of a building, it's anthropogenic. Any construction activity, any non-natural activity that's created the something to be there makes the land contaminated. Okay. However, they further say that if the harm is a result of the presence of air or water or decaying matter, then you are denied the relief. And that's key in 2 main areas. The air exclusion was to prevent mineshaft grouting costs from being eligible, and the water exclusion was there to disallow flood prevention costs, both of which were eligible for pre-2009 expenditure. So that was a significant reduction in the amount of the relief. And the key question you need to ask is, would you have carried out these works if that something was not in or under the land? And then if you do have a contaminated site, then it's anything to prevent, minimise, remedy or mitigate the effects of the harm being caused, and any assessments of the land, so site investigation costs and the like, to determine the remediation strategy. The only exception to the industrial activity is naturally occurring radon is allowable, and also the on-site treatment of Japanese knotweed, which is unfortunately blight for many sites. So hopefully that's a useful overview of the qualifying works. Just a couple of things, because in many cases people enter into joint ventures. You can have 2 types of joint ventures, typically a limited company where a new legal entity is formed, and that entity is subject to corporation tax in its own right, irrespective of the tax capacity or tax status of the shareholders. It is the limited company who makes the land remediation relief claim, and then the shareholders in that situation will get the benefit through the dividend distribution. And all the assessment, the requirement to acquire a major interest, the requirement not to be a polluter, are all assessed on the limited company. The only thing to watch out for is that if the polluter is one of the shareholders, if they have a controlling interest in that limited company, then the limited company is prevented from claiming the relief. So it's just something to bear in mind. The second and more common legal entity is a limited liability partnership, because it is tax transparent, which means that effectively the expenditure is incurred by the LLP, but any tax liabilities in association, related to the profits arriving from the development within the LLP, are assessed on each individual LLP member. Now, the LLP still is the one that needs to acquire the major interest in land, but then the ability to claim the relief is then assessed on each individual member. So if they're a non-taxpayer, such as a local authority or, Homes England or a pension fund or anyone who does not pay tax effectively, then they cannot claim the relief. In which case, if they are in joint venture with a taxpayer, then effectively the value of the relief is halved for the development as a whole. So if you look at the tax relief as a benefit for the project, then if you've got 50% of the owners in the project as non-eligible, then effectively the benefit for the project as a whole is halved, because only one member can benefit. So quickly, the 5 main planning pointers. The first one is, when you're buying land, if it's partly derelict and partly not derelict, then you should ring fence the derelict part from the non-derelict part and buy it in 2 land titles. Now, that seems, there will be additional fees, legal fees associated with that, and it depends on what the value of the relief is. But those list of 6 items are significant costs, and if you had a building on the site that's derelict and adjacent to it is a building that has been used since 1998, and you buy the site as a whole, then none of the site will be deemed to be derelict and you won't be able to claim the relief. Hence the suggestion to buy it under 2 land titles. And the second thing is, when you're entering into a development agreement, typically from a local authority or from Homes England, the common thing is for the public entity to retain the freehold for the duration of the works and only release it upon an agreed milestone, which is typically practical completion of the development and when the freehold passes on to the ultimate purchaser. Now, the key thing is you need to understand what is the interim land interest that you hold for the duration of the development works. Now, most commonly, it is a license, and if you only have a license, you are unable to claim the relief. Now, the reality is that whether you've got a 10-year lease or a 125-year lease, the SDLT and VAT issues are largely neutral when compared to a license. So you'd be quite within your right to ask for a major interest to enable you to claim the tax relief. Now, Homes England have a policy now that a 125-year lease should be granted in such situations, but we do still see Homes England development agreements with a license, and therefore our clients unable to claim the relief. So always just check that point if you're going into a development agreement with any entity which involves a retention of the major interest. And the third point is just understanding the nature of the parties. So if you're buying a site from someone who cannot claim the relief, so it might be the polluter, it might be a local authority, it might be Homes England, and you are acquiring that site and you're looking to get the tax relief factored into the deal, you need to ask yourself collectively for the deal, Where is it best for the remediation costs to be incurred? Well, it should naturally be in the entity that can claim the tax relief, obviously with everything else being equal. So in this example, we've got two options. Option one is that the polluter, the vendor, carries out all of their statutory cleanup works and sells a clean site, post clean, ready for development specific remediation works. And in that situation, no tax relief on those remediation works can be claimed because the polluter pays principle will prevent the polluter from claiming, and the purchaser, the retailer in this example, cannot claim the relief because they didn't incur the expenditure. Any works the retailer does do post acquisition to remedy any purpose remediation necessary for the purpose of the building being constructed, then they can claim the relief on that. The option two is that the retailer actually acquires the site directly from the polluter prior to any works being carried out, and then they do the works themselves and they claim the tax relief. Now, because in this particular case, which is a real case, the retailer is obviously incurring capital expenditure, so they recovered 30% of the remediation costs by entering into an undertaking with the polluter that they would do all of the statutory cleanup works that the polluter was keen to do before the commencement of any development works. And then it was actually as a result of that tax relief that made the project viable and the deal went ahead. The fourth point is just on the apportionment of qualifying costs. It's really just a general principle that if you've got a qualifying and non-qualifying entity, then you can consider apportioning the costs, but in a biased way between the qualifying and non-qualifying person, so that the qualifying person incurs the expenditure on qualifying remediation works, and to make it equal back to the 50-50 joint venture, the non-qualifying entity puts in an equivalent amount of expenditure to non-qualifying works. And in effect, that doubles the amount of relief and makes sure that all of the tax relief gets factored into the deal. Similarly, with housing infrastructure funding and any other grant funding, it's looking to see whether there is a way of apportioning the grant towards non-qualifying remediation works. And remediation for grant funding is often a lot broader than remediation for tax relief. So there are plenty of examples we've seen where the grant covers both non-qualifying and qualifying remediation works. And by apportioning the grant towards the non-qualifying element, you effectively get the benefit of the grant and the tax relief. So those are those 5 planning pointers. Just to be aware that we're continuing to lobby both with the Environmental Industries Commission and Home Builders Federation to increase this tax relief, because as corporation tax rates have gone down, so has the effective cash benefit of the relief. So we're saying increase the relief. And there's a big push from government on getting small developers back active again and rebuilding that part of the sector, and smaller brownfield sites becoming viable. So we're suggesting an increase in the tax relief for small sites of less than 25 homes, and then a couple of changes to the scope as well. And then finally, just how we help. So generally we work with the project team very closely, often with the environmental consultant. So we've done a lot of work with WIG, where we work collaboratively on the preparation of the site investigation reports, just to make sure it's absolutely clear where the boundary is between qualifying and non-qualifying works, which is particularly important in relation to some of those abnormal costs I was referring to earlier. So that concludes the talk, but if there are any questions, I'm happy to take those.